Well, guys, we just want to do a little group video, our Tuesday morning meeting. We thought we'd talk about markets because they've been so interesting lately. Things going on in North Korea versus South Korea. And we've got, of course, all the issues going on with Europe and the concerns about the euro, the fall of the euro. And I just thought I'd get everybody's perspective on things. I for one, have one thing that I want to point out. I just thought this was interesting. Looking at this chart behind us, as a matter of fact, maybe Brad, you can zoom in on that chart. What I think is interesting is, people being concerned, and you heard in the news, the headline in the news was that, what was it, something like a global sell-off. And I was joking around with the guys earlier that, if you think about it, it wasn't a global buy-up, because if you think of it, there is always a buyer when there's a seller. They call it a global sell-off. The media has to make it very emotional and very fear-packed, and they have to get you in a hot state, as we like to say, because that's what gets people their eyes glued to the screen on TV, or gets them to buy magazines and things like that. But I just think it's interesting when you look at, excuse my arm there, but if you look at the ups and downs in the market over, this is the chart for the last year, you notice that it goes down, up, and then down, then up, and down here. But basically where we're at is just a little bit higher than where we were right there. Now, there wasn't a person in the world thinking about, oh no, gotta sell everything and get out, like you're hearing in the media right now, back at this point in time, back in February. And yet, we're actually higher than we were at that point in time. But what happens is, now that we've got things in the news going on that are exciting to the media and scary, now they're starting to talk about people selling around the world. Well, it's the same thing that happened before, and it's the same thing that happens on an ongoing basis in the investment markets. Ira you had something you were reading a little bit earlier. Just hit that. I thought this was interesting, this book.
Yeah, it comes from this book, Discovering the Minds of a Woman, which even my wife said is not possible.
Oh no. Do we need to edit that? No, we can let it go.
That's another video.
It says here, no matter which way you look at it, marriage is a commitment, a long-term commitment. And in some ways it is like the commitment required when one invests in today's mutual fund market. You don't get involved in mutual funds unless you are willing to stick with them over the long haul to get the long-range benefits. The chances for success in the short range are less likely, since there are so many volatile ups and downs over the short term. Marriage, like the mutual fund market, needs to be regarded with a long-term mentality, or long-range mentality. Since marriage, like the short-term market, can have many ups and downs, it is difficult to measure success by today's market value alone. If you recognize the absolute necessity for investing in marriage for the long term, and are committed to persevering through the ups and downs, then, like mutual funds, it will pay off with enjoyable dividends.
I think that's, somebody was talking about a marriage and just the whole fact that most people don't, a lot of people go into marriage and a lot of people don't succeed. I mean, the percentage of marriages that end in divorce. And one of the comments that somebody was making, that it was because of lack of proper expectations going in. And it's very much like investing, if you think about it, because we expect constantly markets to go up. A lot of times people bail out when things aren't going exactly as we expected. And it's getting those proper expectations that markets, they're going to go up, they're going to go down, they're going to do this, this is going to happen. That's all part of markets, number one. Number two, we were talking about earlier, Brazil. Evan, do you remember the numbers from that presentation?
Well, I know that the market return was still 17 above inflation, but it was like 2,400% or something like that over the period of time, the average rate of inflation, and the total was several thousands of percent inflation, but the market still outperformed 17% above that, which is huge.
And the point was that, Brazil was literally collapsing. The country was collapsing, and people were concerned about their currency collapsing, and it was happening. There was inflation in the thousands of percent, and yet the only thing that survived it was their stock market, which is the thing that most people they get scared about. They go, oh no, I've got to get out of stocks because this is happening. And I think it's like I'm in this pool, I'm drowning. I gotta get rid of this life preserver. This thing is just dragging me down.
But, you know, the other interesting thing about Brazil, you know, everybody talks about how much money we're printing here. Brazil, during that time of high inflation, they had like 7 different currencies that they kept getting rid of the old currency and having a new, and getting rid of that and having another one.
That is interesting. That is interesting. That was in the presentation
Yes.
as well. Okay, I didn't pick up on that. That's really good. Yeah, that's something we want to get for you all out there. Is we want to go through that. There was a presentation that a friend of ours put together. It was really, really good. You know, so market ups and downs, they're normal. They happen all the time. And if they didn't happen, we wouldn't have the excess return that we have in the stock market. And it's not something that we necessarily need to get all worried about. Mark, John, we didn't say anything. Any.
You know, the thing I would say is just, as investors, you've done what you can in the account. You've diversified the best that you can. And now you've got to give that investment objective, regardless of what it is, time to do what it's supposed to do.
Right.
And if you don't do that, you're committing that cardinal sin of shooting yourself in the foot. You're just not giving it time, regardless of what the time horizon is, for it to do what it's going to do naturally. You just have to be patient. And that hits on the point that you made earlier. If we didn't have volatility in the market, we wouldn't have returns, period. So you just have to keep that in mind. And it's hard to stomach that volatility, but you just have to remember that.
But but that's the reason why we have the investment policy statement, and why it says time horizon, and why the different portfolios have different time horizons, being 3 to 5 or 6 to 9 or 10 plus years, is to encompass the full range of all these different market cycles.
You know, we live
around the world.
The way I look at this is we live in such an instant gratification society. And I want to take a 10-year return portfolio and have it do something in 6 months.
Yeah.
Not going to happen. I mean, it's not going to happen. Or I want to take a 5-year return portfolio and have it do something, regardless of the time frame.
Yeah.
You know,
Well, just going and selling, it would be like, gee, am I going to go sell my business because the economy's not going well? No, I'm not going to go. And you know, that's the last thing that you think about, but that's what people do
all the time
in times like this. But you know, really good points, everybody, and just we'll you know, kind of keep up to date with what's going on and do videos like this from time to time as we like to, and just stay disciplined, because it is the disciplined investor that ends up ultimately being successful. Remember the Dalbar study. We always talk about the Dalbar study here in the office. You know, the average investor only holds mutual funds for 3 years, and that is why the average investor barely outpaces, well, doesn't even outpace treasury bills over time, but they get stock market risk because they don't understand the fact that discipline is what it takes to be a successful investor. And don't forget, you know, when we see the stock market doing what it's doing right now, there is something in your portfolio that nobody's talking about that's doing well right now. It's treasuries. There is always something in your investment portfolio that's going up in value to help us, you know, sit through and wait through this stuff. Because you know what? Look at it. It doesn't last forever. This too shall pass. I don't know where the next 20% move in the market is, but I do know the next 100% move in the market is always up. And that's all right.